Hello, welcome to the Freedom Finances Podcast. My name is Bradley Valentine, and today is Thursday, September 19th, 2024, and we've got a lot to talk about today. We're going to be focusing on the Federal Reserve's decision to drop interest rates by 1/2 of a point, and what immediate impact this has to the economy, as well as what future impact this will have. First, we're going to start to talk about the Federal Reserve a little bit and what this decision means. Now, at Freedom Finances, we want to build your financial literacy, and while understanding the history and all the intricacies of the Federal Reserves is not 100% necessary to that journey, it's still great to build an understanding of the U.S.'s economy and governing bodies. So let's just start with some history about the Federal Reserve. And the Federal Reserve, often referred to as the Fed, which I will refer to today, was first established with the Federal Reserve Act of 1913 with the purpose of creating a safer, more flexible, and more stable monetary and financial system. Today, the Federal Reserve plays a larger role in the economic system of the United States as it supervises and regulates banking institutions while also conducting the major United States monetary policy through money and credit conditions. Now, much of that specific language was quoted directly from the Federal Reserve itself at federalreserve.gov, but an easier way of understanding the Federal Reserve is this. It's a governing body that regulates interest rates, our financial system, and our banking system in order to protect the economy and the consumers of the United States. So let's get into this news a little bit about the Federal Reserve lowering interest rates. So as is stated in their statement, they lowered interest rates by, quote, 1/2 percentage point to 4 3/4 to 5%. The Federal Reserve stated that, quote, recent indicators such as the economic activity has continued to expand at a solid pace. Job gains have slowed and the unemployment rate has moved up but remains low. Inflation has made further progress towards the committee's 2% objective but remains somewhat elevated, unquote. The Fed's main objective over the last few years was to lower inflation rates. If we take a look at some basic understanding of economics, we can understand what their thought process was. So by increasing interest rates over the last few years, they hoped that consumer spending would drop, thereby dropping demand. With lower demand, we get lower prices, thereby getting lower inflation. So we can take new home purchases as an example, because over the last few years, the home prices have skyrocketed. And because there was such high demand, the sellers of the homes were increasing their prices and inflation was going up. Home prices is such an important factor in our economy. So by increasing interest rates, the Federal Reserve made an artificial increase in price, thereby attempting to lower home prices by lowering demand. If home prices are high and interest prices bring up the new homeowner's monthly mortgage even more, then the buyers are less likely to purchase a home. Now, while the Fed stated that their committee's goal of 2% inflation is nearing, but not yet achieved, they still decided to increase interest rates. So why is that? This is because of what they said in their opening statement, which is that the labor market has been weakening. Job growth has stagnated while unemployment has been going up. The Federal Reserve is hoping to artificially boost the economy by allowing spending to go back up from consumers and businesses by decreasing the interest rates. So what this means is more spending is good for the economy as it stimulates businesses and tax revenue. The assumption is that more spending, more income for businesses, the better the income is, the better the profits are for businesses, the more likely they will start hiring and hopefully decrease their attrition rates. Now, obviously, this is oversimplified, and there are many other factors and nuances to take into account when looking at lower interest rates. However, This overall sums up the idea of what the Federal Reserve was looking to do by increasing over the last few years interest rates and now decreasing interest rates. So now that we understand who the Fed is, what they're doing with the interest rates, let's take a look at some impacts from the decision and some potential impacts into the future. So we're going to look at the stock market and the prices of the stock market. And while the Fed did not necessarily lower interest rates just to give the stock market a boost, it is a good measuring stick of the mindset of investors. So the decision to lower interest rates was made on Wednesday, and today on Thursday, the stock market made some major steps upon open. We're going to start with the S&P 500, which is a measurement of the top 500 U.S. companies. It opened at $5,702, higher than Wednesday's close. As I record this episode, the prices continue to go up even higher with the S&P and almost all of the stocks that I'll talk about here in a couple minutes. The Dow Jones Index is a near record high of almost $42,000 this morning. Meanwhile, growth stocks like Tesla are performing at $233.99 upon open this morning, and it's even performing better as the day goes on. Apple hit $225 upon open, and VOO, which is a favorite ETF for many investors today, is performing wonderfully at $524.88. Many of these prices are record or near record high for these companies, stocks, or investments. Now, obviously, stock prices are volatile, and investors and traders are extremely susceptible to news, especially major economic news. I posted a poll on X asking when, if at all, the interest rate cuts will make a positive impact on the economy or the labor market. 80% said that in 1 to 6 months, we're going to see some positive impact. So while prices are up right now, it's exciting to see. It's good for your investment portfolio. Many people think we won't really see a major impact in the next 1 to 6 months. So let's try to figure out what the future impact on our economy is going to be, if there is one at all. So let's go back to stock prices, and we've already talked about how lowering interest rate means higher prices, especially in the stock market, but let's expand upon that a little bit. Stock market obviously moves upward. It generally moves upward every year, year after year. Assuming that there's not a national economic emergency, it would make sense to assume that lower interest rates will boost some movement in the stock market. So we already know that it moves upwards, so we might see even higher percentages moving upward over the next 1 to 6 months or however long interest rates remain low. This year has had some major ups and even downs for 2024, but overall for the market, it's been quite positive. We've seen some near record or record highs and amazing growth. So we should expect that interest rates start to impact businesses and consumers, and investors will be more bullish and drop more money into the market. This will lead to long-term and short-term increases in prices. It's important that we don't just think about the stock market when it comes to interest rates, because many who are trying to gain financial literacy don't just want to spend all day talking about or thinking about or looking at their stock market portfolio. So let's expand our thinking a little bit more. One major reason for the initial increase in interest rates a few years ago was because of the housing market, as we discussed earlier. The housing market was looking at record prices in houses. Many homes were at record prices. Prices just kept going up, which is not good for those who are looking to buy a house. So prices have continued to increase, unfortunately, even with high interest rates. But the growth price rate did slow down a little bit with interest rates. So if consumers are feeling strong, bank accounts are strong, investment portfolios are strong, their jobs are strong, it's likely that people will continue that movement to buying new homes. Now, if that trend does continue, what does that mean? Higher demand in the housing market with lower interest rates means people are going to buy more houses. Higher demand means that people are going to increase the price of their home. So we're going to kind of reverse the progress we've made over the last few years with higher interest rates to decrease the housing prices. And likely what we're going to see is housing prices continue to climb in the United States for the foreseeable future. After looking at the housing market, we should also evaluate the labor market. While pundits and even the government has tried to sugarcoat many reports, simply put, the labor market has been weak, whether it's this year or the last couple years. Layoffs continue, unemployment continues to increase, and hiring is slow. Now, more consumer spending could potentially increase business profits, which often leads to better hiring practices, less layoffs. So this interest rate cut from the Fed hopes to jumpstart the labor market back into good standing with the U.S. employee base. Now, there are still several months to go before we see a full impact of these interest rates, but it is important to understand that this interest rate is only a small part of the future of the U.S. economy moving forward. This 0.5 percentage point decrease will likely be one of multiple interest rate drops over the next several months. Hopefully, after multiple interest rate drops, the positive effects of this movement will start to snowball. It's important to understand that this move will have other impacts on our economy, such as lower interest rates for consumers to save in their savings account with their local bank, or even long-term savings such as bonds and CDs. So the trade-off for lower saving rates for consumers is potentially lower prices on anything that the consumer might spend with interest, such as a home purchase or a new car purchase. However, it's also important to understand that while this move is likely a strong one for the economy, we will and have already seen an increase in prices. Some price increases, such as those in the stock market and securities, are a strong thing. Some price increases will be a bad thing for some, such as the increase in home prices. Now, those who are looking to sell their house, this will benefit them if prices go up. Of course, they likely will have to buy a house. Therefore, that trade-off of winning a little bit with higher prices is diminished quite a bit. Keeping the interest rates high was a move in the past to assist the economy from creeping inflation, and dropping interest rates now is a move to assist the economy in the labor market. We'll have to wait and see the real impact over the next 3 to 6 months. It's possible that we're going to see more interest rates drop over the next 3 to 6 months. It's very likely that the Fed will make the decision to continue this effect, to snowball this effect, to have a great effect on the economy. So take a look at your investment portfolios today. See what that number is. See what percentage it grows in the next 6 months. See what this impact has on you. All right. Well, thank you so much for listening, and that's all we have for you today at the Freedom Finances Podcast. I hope you enjoyed listening, and I really do hope you learned at least a thing or two today that can help you with your financial literacy or grow your financial literacy in the future. Be sure to follow us on X, Facebook, Spotify, and wherever you find your podcasts. Have a great day.